Good morning, everyone. I'd hoped that we'd start by talking about productivity and some of the data that you've just said, well, no one really knows. And but the question with AI in the US economy is what has happened thus far, right? Yes. And so I'll hit you with some of the official data that I've been tracking, and you can tell me whether the utility of it or not,
okay,
right? Which
I'm
is,
ready.
In US productivity, I always go with the Bureau of Labor Statistics measure of output per hour X non-farm business sector, right? And if you look at the data over 50 years, that chart was really interesting, the side-by-side of electricity and AI. Over 50 years, the average quarterly reading is about 1.9% annual rate on productivity. But something's happened in the last 10 quarters where it's higher.
Yes.
You know, just under 3%, 2.7%. Do we really know what that is, and is it AI?
We don't know. I mean, that's the part that makes it hard is in productivity numbers, especially when they're happening in what I would think of as real time, it's very challenging to assess or draw it back to exactly what the factors are that have shaped it. You know, in fact, people still don't agree on what happened in the 90s all the time if you look at research. So it's just something to keep in mind. So then what you do, what any good economist or person, any industry person would do is they'd say, well, what am I seeing? What am I seeing? And so right now, while we can't find it in the macro studies that would do very sophisticated empirical econometrics and ask the questions, how much of this is AI, we still can see that there's something going on there. The question isn't, is it happening? The question is, how long will it persist? Mm-hmm. And so clearly something's happening in the economy, but if you make a series, to go back to your question about productivity, if you make a series of one-time adjustments, so say you automate a production line, or you use AI to help in loan application process, you save money once. You don't save money forever. And I mean, you keep saving that money, but you don't get growth out of that. You don't get productivity growth. You get one-time adjustments to the level of productivity of your employees or your process. So what we're looking for is a technology to give us consistently good changes in productivity so that all industries at scale get better, industries figure out new ways to generate revenue, new ways to do product design, new ideas to come and shape the economy. That's the thing that has a sustained productivity growth part. So it's undeniable productivity growth has gone up. What's not as clear is how long will that last?
Broadly, people want to see and understand how AI impacts workforce. Mm-hmm. And more recently, maybe inflation. So if we go back to the 90s and what Greenspan saw in productivity gains contributing to economic growth, there was a consideration around both of those things.
Absolutely.
You said that it's not the playbook to go back to what happened in the 90s and apply today, but what do you see in those things? Is it possible that AI is driving productivity gains resulting in economic growth, but without the inflation?
It is absolutely possible and something we have to interrogate. I mean, right now, as you know too well, inflation's still above our target, our 2% target, and price level's been much higher for a long time, and people are feeling stretched by the high inflation that they see. And now, oftentimes, people say, well, now AI is going to hurt the labor market, and so now I'm in double doom, as people say. But I think ultimately, the way you think many people think about AI is the investment part of any technology can actually boost demand for goods, services, and people, mm-hmm. and can then raise the pressure on inflation. But then the productivity part comes, and that's a disinflationary part. You can see this is all about the timing. And so what we end up investigating is not just the models, but asking questions. Are the build out of data centers raising prices for construction workers? Are the build out of data centers raising prices for, metals and other things that go into them, the raw materials? Are the productivity gains, and then on the other side of that, are the productivity gains already affecting the cost structure of firms? Do they see that? And even if a series of one-off adjustments can actually change the cost structure. And if you look at profit margins, when prices haven't been rising as rapidly as they once were, and firms are saying they don't have as much power to pass through, you would think that they're doing something to help margin protection. And so I think there's something going on here, whether we want to link it all back to AI and then use that as a demonstrative proof that we're in a transformative state. I think that's a little bit too far, but certainly something's happening. And thinking about the productivity growth is exactly what we did back in the 1990s. We saw evidence firms were being more productive. We were interrogating how long that would last. And interestingly, the 1990s, when I said it was the roaring 90s that followed, it was good growth, but it was also a good labor market, a really strong labor market. And so those two things went together because ultimately we had this conversation in the roundtable, and one of the participants made a great point. It's true, this is how economics works, is if an employee using AI gets much more productive, you hire more.
We're listening right now to San Francisco Fed President Mary Daly speaking with Ed Lillo at an event out there in San Francisco discussing the U.S. economy and how artificial intelligence will play a role in shepherding the economy forward. You can continue watching this full interview by typing Live Go on your Bloomberg terminal. Romaine Bostick here alongside, there we go, Romaine Bostick here alongside Katie Greifeld. You are watching The Close, counting you down to the closing bells here on this Tuesday afternoon, a holiday-shortened week, Katie Greifeld, and a bit of a turnaround in this market from where we were just a couple hours ago.
Absolutely. A really interesting about face here by the S&P 500. But let's get into a little bit more detail on what we heard from Mary Daly. Let's get to Bloomberg's international economics and policy correspondent, Mike McKee, to break down that conversation. And it's interesting, Mike. I mean, the conversation is about AI and the economy. And as it relates to the labor market, the big question is whether AI is going to drive productivity or take away jobs. And that's a hard question to answer.
You pretty much summed up what Mary Daly said, is the Fed doesn't know yet. Both are possibilities, and you could have both things happen at the same time. Of course, if productivity is rising, you might need fewer workers. But also those workers might get paid more. It's really hard for the central bank to know where we go with this. And I think that if you've been following the AI story, even people in Silicon Valley don't know. And so it is a confusing time, but it's something that people are definitely keeping an eye on. The real question Daly raised is, when do we know? When does all this sort of start to make sense?
It gets to the idea, though, too, Mike, about how the Fed is going to make decisions going forward based on the potential impact, whether that's a positive impact in terms of productivity, maybe potentially job growth, or the negative impact, such as maybe no job growth or potentially inflation.
The problem, Romaine, is that it could go either way. Again, to be the two-handed economist, you could have a disinflationary impulse if productivity goes up and we are able to save some money in terms of creating things so prices don't have to rise as fast. But also, you could see real interest rates rise if demand rises, because this is all providing more ability to produce things to the economy, and that would mean higher interest rates. So at this point, what we have is the cusp of something really new, which is what Mary Daly was talking about in the past, where you saw electricity come along, and then you saw the PC come along in the 1990s. And each one took a while to get established, but the time frames were shorter. Now, how short is this time frame? When are we actually going to see something that will give us and the Fed some idea of which impacts we're going to see?
Bloomberg economics correspondent Michael McKee there. A nice recap here of maybe some of the potential challenges up ahead for the Fed in a world dominated by AI. When we come back, we're going to take a closer look at that world, take a closer look at the economy, and sit down with the CFO of Chipotle. We're going to talk about consumer appetites, higher prices, and how that company is navigating both.
We'll also check in with the CEO of hotel giant IHG to talk current travel demand, plus what areas of the world are expected to see the most growth.
And from demand growth to the growing scope of your investment portfolio, a conversation with Christina Minnis over at Goldman Sachs, a big reorganization there when it comes to the blurring lines between public and private markets. You don't want to miss that conversation. Stick around. This is The Close on Bloomberg. Chipotle share is coming off one of its worst weeks in months. Some concerns here about the company's growth, or maybe lack thereof, going forward. A modest bid here on the day as the dip buyers come in. Some investors and analysts seeing a future here under the new CEO and a future under its CFO. But still some big questions about affordability, consumer trends, and just how much of a price hike the company can pass along. Joining us right now is the CFO of Chipotle, Adam Rymer, joining us from out west. Adam, great to have you here on the program. A couple of weeks ago, you had your earnings. Obviously, the big guidance was more or less, don't expect any real growth, at least not for the next couple of quarters. I am curious as to whether what is holding Chipotle back is more a function of broader economic conditions or something specific to the company itself.
Yeah, we think it's definitely broader economic as it relates to our consumers. And last year was a really tough year for the consumer as it relates to inflation and just kind of feeling some uncertainty about the environment. But as we went throughout the year and really leaned in on menu innovation as well as some other areas, we found a lot of success. And we're going to really double down on those items in 2026. And we're really confident about the year ahead.
There's been a lot of talk, not only coming off your last earnings report, but the last couple of conference calls. The idea that there does seem, and correct me if I'm wrong, a strategy to lean more heavily towards higher income consumers rather than going off of for those value conscious consumers. Is that the key strategy now?
I think that was misrepresented a little bit. The things that we're really focused on are menu innovation, which we're going to have 4 LTOs this year. We right now have chicken al pastor, which is fantastic and is a huge fan favorite in our restaurants. It just actually released last week. And then we're leaning in on some other areas like the high protein menu, which launched in January, which we saw quite a bit of success with. And not only are we able to showcase that Chipotle is the place for clean protein, but there's very accessible price points with that menu, starting with a $3.50 single taco, as well as a $3.80 protein cup. But those have been doing really, really well. So we're going to continue to lean in on what our guests want, and that really encompasses all of our guests. But we have seen more strength in our higher income guests, which is about 60% of our sales base.
Well, Adam, I want to talk a little bit about portion sizes as well. Of course, that has been a hot topic surrounding Chipotle. And I'm curious how you're thinking through that, because Chipotle has been shrinking their portion sizes. And I wonder, how that's bearing out in the data, how that's impacting sales and the like.
Yeah, so we are always leaning in on our portions. We are known for having abundant portions. You can customize a Chipotle. You can ask for more rice. You can ask for more beans. You can get double protein. And we have always leaned in saying, okay, ask us, what it is and how you want us to customize our bowl, and we'll lean in on that going forward. And so we're going to continue to do that in terms of how we serve on the front line or even how we serve on our digital make line. And we think this is what really resonates with our customers and really creates this amazing value proposition that we have at Chipotle.
And when it comes to communicating that and, the various other initiatives that Chipotle is exploring right now, my understanding is that you don't have a permanent chief marketing officer in place. And so I wonder how that's being handled internally, putting out that external communication.
Yeah, so we've got our internal team currently, and Stephanie Perdue's our interim chief marketing officer. She's been with the company about 7 or 8 years now at this point, and the whole team is very much intact and executing on the strategy that we have laid out for the rest of this year. It's with chicken al pastor right now. We've got some other sauces and some more protein menu innovation coming later in this year, as well as a rewards program revamp. And we're going to continue to lean in on group occasions like catering and build your own Chipotle, which is designed for groups of 4 to 6. So we have a really strong plan for this year, and I'm confident that this team will execute upon it.
I'm curious about inflation, both for yourself and for your consumers. With regard to your own costs, the cost of goods, cost of materials, cost of ingredients, has that stabilized, that increase stabilized to a certain extent? Or are you still anticipating some volatility there?
We've seen some stabilization, but it's a little bit higher than what we've had historically. So historically, we've usually had about low single-digit inflation, so call it about 2% across labor, across commodities. And right now, for this year, we're projecting that to be a little bit higher, kind of in that 3 to 4% range, driven primarily by beef, as well as a few other items within cost of sales. But everything is still generally a little bit higher than what we've seen in the past.
Is there any anticipation, looking a little bit further out, that not only does that cost stop increasing, but we could actually maybe see some of those costs come down in a material way?
I think so. I mean, I think we'll probably see more stabilization, kind of getting back to that low single digit. There's always a specific categories like avocados and potentially beef, a year or two from now to get some potential declines there, which will help stabilize. But I'm guessing we'll just kind of normalize into that low single digit here in the next couple of years.
I'm also really curious to talk a little bit about your physical footprint, because the plan is that you're going to open up new locations, between 350 to 370 new stores. That particularly caught my eye, given that, we recently heard from Wendy's, for example, actually planning to go the opposite direction. So talk us through, the logic here, the thinking here that, expanding, opening these new stores actually will translate into bigger growth here, Adam.
Yeah, so our new stores are performing very, very well. So we have about 4,000 restaurants in the U.S. and Canada, and we believe that we can get to around 7,000 restaurants in those areas. And so growing at a pace of about 350 to 370 new restaurants is the right pace for us to open really successful restaurants with great returns in areas that we're still able to grow in. And our new restaurants are opening at about 80% of the volume of our existing restaurants. And our year two cash-on-cash returns are north of 60%, with our all-time cash returns north of 70%. So we're really excited about the economic profile and being able to really bring Chipotle's food experience to more people and more communities across the U.S. and Canada.
All right, Adam, great to get some time with you. That is the CFO of Chipotle. His name is Adam Rymer. Let's move on to shares of IHG in the wake of the hotel operator announcing a $950 million share buyback program in its latest earnings. You can see shares rising a little bit here, 1.5%. The company also unveiled its 21st brand, Noted Collection, as it looks to attract more upscale customers this year. Joining us now exclusively to discuss is Elie Maalouf, the CEO of IHG. Elie, great to have you with us. A lot to get into here, but I want to, of course, start with the U.S. and what you're seeing in that market, because we know it was a difficult end to 2025. The momentum that you've seen so far in 2026, what gives you the confidence to say that it will continue?
Thank you for having me. It's great to be with you. First, I really do want to thank our teams around the world for what was an excellent financial performance last year. You saw our RevPAR grew 1.5% around the world. Our operating profit was up 13%. Our earnings per share up 16%. And we're growing the company. We had a record over 440 hotel openings around the world. We added nearly 700 hotels to our pipeline. So the industry growing, our company's growing. We're confident about the future. With regard to the United States, there were some, let's just say, unexpected things last year that weighed on the industry, which we think come off this year in 2026. You had some tariff anxiety. You had reduced government spending and travel. You had the longest in history government shutdown. You had reduced inbound travel to the U.S. internationally. Now, when you get into 2026, these things either don't happen or really just we comp over those. In fact, we get some positives like the World Cup, like US 250 celebration. You got a very strong economy, a strong GDP growth exit rate from Q4. Really still record employment, job growth, but number of people employed is still at a record. Enormous capital spending by technology companies and other, not just tech and AI, but you have energy, infrastructure. That's driving business growth. I mean, you put all these things together, it's hard not to be a little more positive in 2026 about the U.S. than 2025. And what we've seen in the first month and a half in business in the U.S., but actually, frankly, globally, makes us more optimistic.
Right. Well, let's talk a little bit more about the World Cup, because obviously there is a ton of excitement building for this summer. What do past World Cups tell you about what the region could expect here in the U.S., and what are you doing to prepare for that?
Well, look, we're very prepared. We're in most of the major cities where they're going to be, football if you're using the global term, or soccer if you're using the U.S. term. But we're also very present in Canada and in Mexico where games are going to be played. We've got a lot of experience with global events. We're in 100 countries. We're a global company that's very big in the United States, but we've got experience with all these major events. I mean, look, there are industry forecasts that say it could add somewhere between 40 to 60 basis points of RevPAR to growth this year. We haven't put out a forecast. We do think it's going to be accretive. We think it's one of many other things that are making the U.S. outlook stronger for 2026.
I am curious, though, Elie, you have no concerns right now about some of the immigration issues here in the U.S., potentially maybe dampening just how many people would actually travel, foreign travelers, that is, into the U.S. for these events?
We haven't seen that. You know, our booking window isn't that long. The games are still a few months away. Frankly, most companies in our business at our scale see somewhere between 50 to 60% of all their bookings in the last week. Now, long event bookings like this start to come in months before. We're pleased with the bookings we're seeing in our major cities for the World Cup. It's a bit early, really, to make a forecast on it, but we're pleased. We're not seeing any resistance to come. Look, sports bring the world together. And that's always been the case, no matter where the World Cup has been held. And keep in mind, we're a global company. We're very focused in the United States. We think it's going to be more optimistic this year. Mm-hmm. But around the globe, we're seeing positive trends in Europe, certainly the Middle East, where we have a very big business, and that's growing. Southeast Asia has had a very good year in 2025. That continues. And China, which was a bit negative in RevPAR growth for the last 2 years, turned positive in Q4, a strong economy. We had record signings and openings in China last year. So really, globally, everything's taking shape for a better year in 2026.
Well, on that point here, are you seeing any material difference in demand for, I guess, your high properties versus low? So say something like a Holiday Inn on the lower end of the price spectrum, all the way up to, the Intercontinentals, Crowns, Kimptons, and those things on the higher end.
Sure. Look, we pride ourselves on having a stay for everybody. And in 2025, both Holiday Inn and Holiday Inn Express had a positive year around the world. Now, I'd say the upper end, luxury, had an even more positive year. That's been a trend going on for a couple of years. We think over time, the mainstream travel, the middle-class travel will converge. And some years, you find that luxury does better than mainstream. Some years, mainstream does better than luxury. There are strong structural drivers for both. In mainstream, the middle class is growing around the world. In China, the middle class is going to double in the next 10 years. In India, Southeast Asia, similar figures. In the United States, the middle class is getting wealthier. And so the middle class is the heart of the business, and that has strong structural drivers. At the upper end, at the luxury, you've got two structural drivers. First, you've got an aging population that's, however, aging in a healthier and wealthier condition. And one of the main things they want to do is travel. They prioritize live experiences over products, and they're living longer, healthier, and they want to travel more.
Right.
So that's got a structural driver. I think both have a very good future.
Well, Elie, when it comes to the upper end, and we only have about a minute left with you, talk to us about where you see the Noted Collection launch sort of fitting into that portfolio.
We're very pleased to launch Noted Collection today, our 21st brand. It's going to be targeted in premium, which is between luxury and mainstream, right there in the premium for business travelers, for leisure travelers. It's a collection brand. So it's there to collect iconic assets that already have a strong local presence, a strong following, but for owners that want to join a very strong system like ISG. We have 160 million ISG One Rewards members. We cover 100 countries. We got best-in-class technology, leading AI-driven revenue management systems, all the powers that can make hotel performance stronger, while you can keep your own brand and your own identity as a property. So it's a collection for these iconic assets. It's going to be urban leisure. We're targeting about 150 hotels over the next 10 years, and we're optimistic about its growth.
All right, Elie, we have to leave it there. I really appreciate you joining us here, and I think we got to check back in as we get closer, of course, to what's going on with the World Cup here in North America. Elie Maalouf, the CEO over at IHG. Now, when we come back, we're going to turn back to the world of finance, the world of public and private credit, and a conversation with Christina Minnis, global head of the Alternatives Origination Group and head of credit and asset finance at Goldman Sachs. That's coming up next here on The Close, right here on Bloomberg. 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld.
For once we didn't actually show the JP Morgan building.
I know.
Is that out of fashion now?
I wish you should have seen it actually on Saturday. Apparently they lit it up in pink for Valentine's Day, which, by the way, happy belated Valentine's Day.
Thank you very much.
Yeah.
I appreciate that. And happy Valentine's Day to Jamie Dimon. We're going to move on to another big bank, though, and that's, of course, Goldman Sachs. And there's no question out there that the lines between public and private credit markets are becoming a bit blurred. Look no further than Goldman Sachs, which is making leadership changes across its global credit business. I want to bring in, for her first interview in her new role, is Goldman Sachs veteran Christina Minnis. She's now the global head of the bank's alternatives origination group and head of credit and asset finance. Great to have you here, Christina.
Great to be here, Katie and Romaine. Thanks for having me.
So we talk about this Capital Solutions Group. I think they created that about a year ago. They elevated you this year to head of AOG, if all the cool kids say. Explain kind of how this has worked, because you're kind of under that Capital Solutions Group umbrella, but a primary part of your job is to do what?
Well, first of all, Capital Solutions Group, which was started about a year ago, has been a great success, and that was pulling all the public and private product suites that address the needs of our alternative asset managers, financial sponsors, and corporates into one business to come up with the most highly structured, oriented solutions for capital needs for these clients, and also to create a sourcing engine for our investing clients. And that was the genesis of Capital Solutions Group. AOG, Alternative Origination Group, which now I'm heading up globally, is effectively the private hub inside of CSG that basically drives that origination, connects the dots, speaks with clients, what is their financing need, what is their problem they're trying to solve. We bring it back in, we look across all of our product suite from asset-based lending, leverage finance, equity capital markets, private credit. We package up solutions, we offer them to our investing clients, and in addition, our own asset and wealth management division, who is also looking to source product.
So where are the opportunities now in that space? I mean, can you share any of the big deals that you've done? I mean, I know you've only been on the job for a month or so.
Right.
But, yeah.
So I would say we have been really excited about a couple of areas of the economy. Obviously, there's been a lot written about AI and the massive capital need required to fund that growth, and it's the single largest investment in the need for humanity in our history. Let's talk about a $5 trillion number that people talk about over the next 5 years. All that capital has to get raised. It's getting raised across many industries, and so Capital Solutions, our infrastructure financing area, is ripe to help those companies raise that capital.
That money needs to be raised. Is that
Correct.
money going to be spent? Because that's one of the criticisms, that there's a lot of money and a lot of big numbers being thrown around.
It's being spent.
And the shovels are in the ground.
Absolutely,
Yeah.
it's being spent. There was a transaction recently we worked on, which is a great illustration of what we do inside of CSG and the role of Alternative Origination Group. A corporate client came into us and said, I've been financed in the private credit market for a long time. I need to make a major investment in inventory. I'm basically providing energy for data centers in the middle of a large state. I need to acquire a lot of material. We initially thought we'd do a structured solution, off balance sheet, structured finance, investment grade, private solution. But ultimately we came up with a pretty straightforward asset-based loan with a high yield bond. All of that money was raised for them to actually acquire these units. They're going to power the data centers. So absolutely this money is being spent. And what's super exciting about that $5 trillion number, which might sound almost too big, if you unpack all the markets that are open to finance that across private credit, public investment grade, private investment grade, insurance money, there's tremendous amounts of pools of capital looking to support this growth. And so we are really excited about this opportunity.
Well, I want to talk a little bit more about the interplay between the public markets and the private markets right now, because, I mean, there's been this narrative, of course, that there's this incredible blurring of the lines. You've seen a lot of issuers basically hop back and forth between public and private credit. And I wonder, how far we can take that narrative.
In terms of the blurring of the lines?
Yes.
I think they're going to continue to blur, and you start to see it in pricing differentials. So, for example, the deal I just mentioned, when we first started looking at I'll call it the private credit solution, right? That was, obviously not in the public markets. It was probably going to be about 100 basis points better because it was going to get a higher investment grade rating based on how the structure worked. By the time we brought it to the market had gotten super aggressive in the traditional markets. That delta collapsed to maybe 50 basis points. So you used to see a pricing differentiation. You also used to see pretty significant documentation differentiation. And a lot of those features are converging. We just did a very significant private placement for a sports franchise. in one of the markets, having callable bonds is kind of not something you offer up to investors. This transaction went so well in a classic private market, it actually was able to accomplish a call feature. Again, something you get in the public markets that's now importing into the private markets. So we really do see the blurring of the lines. And I think it's terrific for companies to avail themselves of this flexible capital. It's very good for our economy.
Well, I wonder how, this interacts with the IPO market, because I know that, Goldman said in your 2026 M&A outlook that the concept of staying private forever has shifted from a hypothetical to a credible strategic model. And I think, a lot of people would agree with that or have come around to that line of thinking over the past year. But then you see a company like SpaceX, for example, reportedly considering an IPO. And it seems like there are some limits to some companies eventually will need to tap the public market if, they're really trying to build data centers in space and things along those lines.
Yeah, I think if you take a look at the equity market and its start in 26, it's pretty extraordinary. Even with the volatility, equity issuance is up over 70% year to date. IPO volumes are up over 80% year to date. And importantly, those IPOs have performed very well. They're up on average 9%. So the IPO market is a very important market still to support growth of companies. And I think, if David were here, I think he'd comment on size probably matters immensely. Will very small companies go public still in the new paradigm? Maybe not. But medium-sized to large companies will look at both markets and choose would they prefer to be public or private. And it's a choice.
But are you seeing any sort of break in that choice? The idea that some of these companies that I think the market is waiting on, these larger companies, that maybe there is no real fundamental reason. If you can continue to raise money in private markets, why do you want to go through the Wall Street rigmarole every 3 months?
I think it's a personal choice. Yeah. I think it gets down to how much capital you need and the cost of that capital. Historically, putting aside my comment of the convergence, private markets have come at a premium to public markets because by nature there's less of an auction going on in a private setting. But what we see in these private order books, significant order books building in these private environments. So I think over time it will be a choice. And I think some companies will stay private for longer.
All right, Christina, that's a great place to leave it. Really great to have you, and congratulations on the new role. Christina Minnis, Global Head of the Alternatives Origination Group over at Goldman Sachs. When we come back, we're going to check back in on the markets as we count you down to the closing bells and take a look at, three stocks on the move today: Warner Brothers Discovery, Paramount, and Netflix. That's coming up next in our Stock of the Hour. This is Bloomberg.
Our stock of the hour is Warner Brothers Discovery. You can see shares higher by just over 3% as the battle over its business heats up again. The media giant saying it is officially reopening sale talks with Paramount Skydance after receiving its most recent sweetened offer. Paramount replying last hour that it is, quote, prepared to engage. Netflix, meanwhile, has given Warner Brothers 7 days to discuss Paramount's most recent bid. Joining us live is Chris Palmeri. He is team leader of media and entertainment right here at Bloomberg. So Warner Brothers still describing Netflix as its preferred bidder. Give us basically the lay of the land here and what could happen over the next 7 days, Chris.
Well, Warner Brothers has repeatedly said no to Paramount's offers, but Paramount hasn't given up, and they've kept sweetening the terms. And then it apparently the last few days privately said that they would go beyond that $30 a share that they suggested, said $31 if you reopen talks, and maybe even higher. So that's where we're at right now, this limited 7-day window for Paramount and Warner Brothers to once again try to come to a deal.
Well, I mean, it's kind of interesting, too. We talk about some of the language about potentially going to war. Obviously, they're going to apparently go to this meeting and annual meeting and propose some board seats here. I mean, this isn't really just about the price, is it? I mean, there's a lot more going on here underneath the scenes. And I guess my question for you, Chris, is what exactly do Warner Brothers shareholders actually want?
Well, we've spoken to a lot of them, and they want to reopen talks. They're all about getting the absolute highest price. And right now, it's not clear that the Netflix offer, because it has a spin-off of the cable channels and is contingent on some other issues, how much debt goes with the spinoff, that it's dramatically better in any way. So this is a clash really between the Warner Brothers management that seems pretty clear they would prefer to be with Netflix. They're talking about the cost to the Hollywood economy and the debt that Paramount would have, and issues that really aren't about just the share price.
And Chris, what sense do we have of how the shareholder base is thinking about these different bids and whether or not either one is preferable at this point?
Well, you haven't seen a huge turnout in the tender offer of Paramount asking Warner Brothers to tender their shareholders to them. And that's because people are just waiting to see where this plays out. And so March 20th is the deadline. If Paramount and Warner Brothers can't come to a new deal, then Warner Brothers shareholders will get a chance to vote on the Netflix deal. My guess is that if they don't come to a new terms right now with Paramount that are dramatically higher, that the Warner Brothers shareholders will, in the end, support Netflix just to get that deal done.
Hey, Chris, I do just have to ask you just about some of the political dynamics that may be involved in this, maybe not. Of course, a lot of people talking about that interview that didn't necessarily air on the Stephen Colbert show last night, and the idea as to whether this whole deal might be tipped in favor of Paramount Skydance, primarily because of the political alliances and considerations.
That's certainly been a topic of discussion. That's certainly what Stephen Colbert and his guest, Representative Tallarico, said on the show that didn't air last night but aired online. That this is a big push by the White House to influence coverage in the media, and that big media executives like David Ellison of Paramount are indeed responding to that and playing down some things and so that is part of the dynamic here, no question.
All right, Chris, really appreciate your reporting. That is Chris Palmeri, team leader of media and entertainment over at Bloomberg News. Coming up next, we're going to take you to the closing bell with Julie Biel of Kayne Anderson Rudnick.
10 minutes away from the closing bells, a market that opened lower, now in the green, though clinging barely to some gains. You got some big bumps from Apple, Nvidia, and some others, but a big drag down by some of the other big names like Microsoft and Tessler.
And you can absolutely see that when you take a look at the averages right now. The S&P 500, like you said, trying to cling on to those gains, but the NASDAQ 100 actually dipping into the red just in the final 10 minutes of this Tuesday trading session. We'll see what happens, of course, but certainly sort of a lackluster start to a new week after that big drawdown that we saw last week. Meanwhile, you take a look at gold actually dropping on the day. We're below $5,000 an ounce, down about 2%, and the bond market pretty much doing nothing right now. We saw that big drawdown in yields last week, a big rally in the bond market. Pretty quiet right now at 4.05% on your 10-year.
Pretty quiet here, earnings season. Not really as active as it was over the last couple of weeks. Seeing a big bid right now into transports and raising a lot of questions about the rotation that we've been seeing in this market really all year long. Julie Biel, she comes into the program now, portfolio manager and senior research analyst over at Kayne Anderson Rudnick. And Julie, I do kind of want to start with where investors' heads are at. I mean, coming off, I think what was the worst week for the S&P all year long. Seeing some dip buying, and yeah, there are some big tech names there, but once again, you see a lot of people kind of sniffing out, I guess, what would be considered industrial names or real economy names, and I guess I'm curious as to what, if that signals, if at all.
What I think it signals is everyone has gotten a bit burned by, long-standing software names that they thought were really safe havens for them, and finding them get undone in the matter of a couple of weeks, and recognizing, hey, I want to own hard goods, hard assets, companies that make stuff because I feel good about the cyclical upswing that we're seeing in this economy. And I think that that's a logical conclusion to make, but there's kind of a limit, right? We can't all be industrial PMs exclusively. And I think that it kind of misses the boat in terms of what really is the disruption we should be expecting over the very long term from AI.
Well, it seems like every time we get sort of, any sort of news article saying that, okay, this new AI tool is going to, upend whatever, finance, upend trucking, upend whatever, investors go running for the hills and start to look for something that is maybe AI proof or not AI exposed. Do you see that as becoming more of a narrative as we get deeper into the year?
Yeah, I think that the drawdowns in these software names and then insurance and then in real estate has been really pretty painful. And so everyone is kind of looking and trying to figure out what can I buy that's not going to have this same level of headline risk. And I think it ignores some of the important factors that are driving these businesses. It's very likely that AI is going to disrupt all of us in a pretty meaningful way, but it's not clear to me, and I don't think it makes a lot of sense to be directing a ton of client money based on very unproven facts. Many of the companies that are coming forward and purporting to be disruptors, these are Silicon Valley darlings that, have a great amount of rhythm and they have lots of growth opportunities from them, but they haven't actually demonstrated the hardest thing, which is the distribution and the ability to sell into enterprise. And that is much tougher and takes much more time to figure out.
And it's interesting, Julie, in the past couple of weeks or so, it seems like the conversation, at least in the public equity markets, is less about who the disruptors are and who is actually being disrupted. We've seen the AI scare trade, as it's being called, really rolled its ways across sectors. And I wonder how you're navigating that and what your clients are asking you.
Yeah, I think the major thing is to kind of recognize that there will be software businesses that just do not have enough moats or protection around them to really be able to withstand any kind of threat from smaller disruptors. And so the real measure is if you're a software business and all you're doing is kind of optimizing, which means really just automating, you don't really have an information protection advantage. And so you are ripe for disruption. If you're the type of business, however, where you're really embedded in workflows and you have proprietary data that isn't accessible to most of these small companies, I think there's more to it than just, having this great tool that's going to sit on top of everything.
And I do want to talk about a specific sector, and that is healthcare, because I'm taking a look at your notes. You say that healthcare is worth paying attention to and adding exposure. And I wonder where within healthcare you're looking at right now, because you think about insurers, for example. There's been a lot of policy noise, and there's a lot of places where things might look a little bit risky. So specifically, where are you looking to add maybe a little bit to that exposure?
I think within healthcare, to us, especially in the small and mid-cap space, biotech is kind of a non-starter. These are really binary outcomes. These are lottery tickets that I think is not really a really healthful place to be in. But when I think about, these tools providers, something like an Iradimed or a company like West Pharmaceutical, where you're less dependent on a single drug being approved, you're less dependent on reimbursement, and it's more about the expanding growth of any kind of healthcare that we need. Those, to me, are better positioned, better insulated. And the way that I really try to think about these businesses is what is the earnings durability of them, right? Are they dependent on changes in regulation, changes in healthcare reimbursement? And trying to find the ones that don't have that dependence, to me, that's a safer place to play in healthcare.
I'm curious to get your thoughts, Julie, on what's been going on with financial stocks. Overall, decent performance, certainly to start the year, and really over the last 3 or 4 months here. What is that a function of?
I think just it's a function of people recognizing of where the yield curve is and where the opportunities are to really expand NIM for a lot of these businesses. I think there's also this recognition that, for the most part last year, regional banks just didn't get to participate at all. And now there really seems to be an opportunity for them to improve, especially if we have any kind of deregulation happening and the ability to do more with the balance sheets that they have. I think that they can become bigger players, and they're certainly we're trading at very attractive multiples.
Well, Julie, when you say that they could become bigger players, how does that happen? Do you expect to see any consolidation maybe among some of those smaller banks?
I think for sure we have to see more consolidation. The level of fragmentation that we have is unique, actually, in this country. When we look at a country like Canada, there's so much more consolidation in their banking system. I think there's still a lot of opportunity for that. And I think if we have antitrust that's a little bit weaker and looser, you could see a lot more of this consolidation. And I think that they can make a real claim to that by saying, it's really clear that the money centers have this huge advantage, these fortress balance sheets that make it hard for them to compete. For them to get a little bit bigger, it really allows them to be a more relevant competitor to other borrowers.
Julie, always a pleasure. Julie Biel, Portfolio Manager, Senior Research Analyst over at Kayne, Anderson, Rudnick, counting us down to the closing bells here in New York. closing bells, it looked like most of the major market indices going to end the day flat, Katie Graffeld.
Yeah, flat is a good way to describe it. Maybe the color is different when you take a look at the S&P 500 to the NASDAQ 100, but really small moves overall might be impacted by the fact that I think a lot of folks took this week off.
Yeah, not us here.
No.
We are always for you here on this holiday shortened week. And it gets to this idea here as to where are the next big market catalysts right now. Of course, earnings season winding down. Still have a big one from NVIDIA next week and a few coming after the bell tonight. A full breakdown starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here alongside Katie Graffeld, taking you through to that closing bell with the global simulcast. Carol Massar, Tim Stenevik, they join us now as we welcome our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube to parse the most crucial moments here in the trading day. Carol Massar, Tim Stenevik, great to see you once again here on this Tuesday afternoon.
Did you bring us back any Olympic chocolate or anything like that?
Olympic chocolate? I don't think that's a thing. They passed out some other things at the Olympics.
You did bring back
those.
How about
some
a medal,
goodies.
Romaine?
Nothing coming this way at the newsroom. I'm just saying.
I walked by your desk earlier today, Carol, and you weren't there. I just assumed you had the day off.
No, I've been working. Anyway, good to have you back. Even split in the S&P 500. I feel like this is a market looking for direction, whether we get it from earnings as Walmart reports and retailers. We also get Fed minutes tomorrow. And then, of course, you have an inflation print later on this week, an important one. So maybe we're just looking for something to help us figure out what happens from here.
Well, in the early part of the day, it was looking like it was going to be tech under pressure, with the S&P down as much as 0.9%. And a lot of those mega cap tech companies falling. But like Carol said, the S&P 500 searching for direction a lot of the day. By my count, more than a dozen times, Katie, moving between gains and losses today.
Wow, so you really had your microscope out, taking a look at that S&P 500. I will say the NASDAQ 100,
like that.
It looks like it will
Real
finish.
shoe leather reporting there.
Always do,
Finish
guys.
in the red.
That's how I roll.
But these are small moves overall. It really feels like this was sort of a wait-and-see sort of day.
Well, after coming off one of the worst weeks in quite a few months here, you saw the dip buyers did come back in here on this Tuesday afternoon, but the net effect of it all is really a market that is going to end the day effectively going nowhere. It takes a while for these numbers to settle. The Dow is going to finish in the green, but only up about 0.1%. The S&P is going to finish in the green, but only up about 0.1%. The NASDAQ composite is going to finish in the green, but only up about 0.1%. We should point out the NASDAQ 100 is going to close out the day down 0.1%. And you take a look at the Russell 2000, we'll just call it a wash here, down about 1 point. So basically unchanged on the day.
It's a 0.1% kind of day in a big way. As I mentioned earlier, though, if you dig inside something like the S&P 500, more of an even split. So there were some stocks that actually moved big time to the upside and big time to the downside. 241 names, though, overall, Katie, gaining ground in the S&P 500 on this Tuesday. 261 lower on the day, 1 unchanged.
Absolutely. Things got a little bit more interesting. When you take a look at the sector level here, you can see the circle is really a mix of colors, basically two, but there's a lot of them. Anyway, real estate was your biggest gainer on the day. That sector gaining by 1%. Financials also having a pretty good start to this short week. Tech higher by about 0.5%. Meanwhile, in terms of what didn't perform, consumer staples, your biggest loser on the day, down 1.5%. Energy, Carol, also down as a sector by about 1.4%.
All right, guys, let's get to some earnings crossing the Bloomberg terminal. We have Caesars Entertainment crossing as we speak, bringing up the numbers. Just a few headlines here. Let's look at fourth quarter loss of $1.23 a share. Fourth quarter store net revenue, $2.92 billion. That compares a little bit above the estimate on the street of $2.89 billion. Right now, you're seeing the stock little changed here in the aftermarket. So maybe looking for a few other headlines when it comes to their business and getting an idea on the world of gambling. So we'll keep an eye on that. In the meantime, I'm going to go to some of the individual gainers. number one gainer in the S&P 500. In fact, up about 12% in today's session. We're talking about Norwegian Cruise. This one, after activist investor Elie Investment Management said it built a more than 10% stake in Norwegian, also sent a letter and presentation to the company's board urging changes to unlock what it believes is more than 150% upside for shareholders. So again, about 12% upside in today's session alone. Let's go to another one, Massimo. This one up 34%. No surprise. It was a target bought out by Danaher, agreeing to buy the medical equipment firm for $180 a share. That's a 40% premium over Friday's close, a total enterprise value of about $9.9 billion, allowing Danaher to gain a foothold in the medical supply business. So some M&A Tuesday action happening. And then TripAdvisor, let's go on over to there. Up about 9% in today's session. This is after Starboard Value delivered a letter to TripAdvisor's leadership highlighting prolonged underperformance and announced plans to nominate a majority slate of director candidates for the 2026 annual meeting. Keep in mind, TripAdvisor's down almost 30% year to date. We got some more earnings. Romain, take it away.
Yeah, Cadence Design, of course, makes software to design chips. Out with its report right now. 4Q adjusted EPS, a beat at $1.99 a share. The street looking for $1.91. Revenue beating slightly at about $1.44 billion. Here's your guidance for the full year 2026. The company says expect revenue in a range of $5.9 to $6 billion. The low end of that range, right around the average of street estimates. As for EPS for the full year, $8.05 to $8.15 a share. That's the guidance. The low end of the range, basically right around the average of street estimates. A slight pop in the shares, now on change actually, but they were up about 7% here in the after-hours trade.
All right, you are looking at some earnings. We're still waiting for a few more companies to report, and then, of course, the big one coming next week. I do want to take a look at some of the stocks that were on the decline today. I want to start with the worst performer in the S&P 500. This is the owner of Napa Auto Parts, genuine parts company, GPC. Shares fell today by more than 14.5%. This after the company announced fourth quarter earnings that fell short. Net sales also came in below expectations. The company, though, is going to split into two public companies following a review of options for its automotive and industrial business lines. The split comes during a volatile stretch for the automotive business. It's grappling with higher prices, higher costs, economic uncertainty, and affordability challenges for consumers.
Do you know how to change your oil, Tim?
Sorry?
Do you know how to change the oil in your car?
I know how to take it somewhere to be changed. Romain, here's the deal. Here's a real thing. Nobody changes their oil anymore because what do you do with the oil? That's the old oil.
You pour it down the sink.
No.
Yeah, sorry, Mr. Environmental.
I
don't want to burst your bubble, but
that's what people used to do.
Yeah.
And it wasn't good.
Okay.
But that's the real reason why it's so hard to change your oil.
Well, what do you do with the oil, Tim?
Yeah. You're supposed to take it somewhere to recycle it, and by the time you do that, you might as well just take your car somewhere to have the oil changed for you.
Like the sewer, you know?
Oh, okay. You guys are killing me. Katie, you're watching Palo Alto
Yeah,
Networks.
we do have some
on?
earnings. Back to business here. These results coming out. They see full-year adjusted EPS $3.65 to $3.70. The estimate had been for $3.87. So that range, of course, falling below the estimates here. The full-year revenue seen between $11.28 billion to $11.31 billion. They had seen $10.5 billion to $10.54 billion, so a bit higher there. You can see the shares right now trying to decide what to do, but the initial read is higher here. They also see next generation security ARR for the full year between $8.52 to $8.62 billion here again for Palo Alto Networks.
Okay, we still got some more names that are expected to report today, including Toll Brothers. We'll bring those numbers to you as we do get them. In the meantime, a couple more decliners here. Also a worse performer in the S&P 500 today was General Mills. The company lowered its fiscal 2026 outlook, citing a more challenging consumer environment. The company said weak consumer sentiment, heightened uncertainty, and significant volatility have weighed on category growth and affected consumer purchase platforms. This is the parent company of cereals such as Cheerios, down 7% on the day today. And finally, Danaher. Carol had the news with this company agreeing to buy Massimo Corp in a deal with an enterprise value about $9.9 billion. Massimo shares moved higher Danaher fell today by just about 2.9%, Romain.
All right, let's get a quick check here on yields here. A mixed day here. You saw on the shorter end of the curve a slight uptick in yields, about 3 basis points for your 2-year yield. On the longer end of the curve, we don't have it on the screen. We should start putting it there, though. The 30-year yield did actually decline, but only by less than 1 basis point here. So something to keep an eye on, particularly as we head deeper into the month of February and into March and the next big Fed meeting.
All right, guys, just watching those earnings. Cadence now up about 1.6%. You got Palo Alto down about 2%, and Caesar now up about almost 3%. Caesar's Entertainment, so some movement, and we'll continue to track some more earnings after the close. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Romain continuing there, of course, on the close on TV, and Tim and I continuing on Bloomberg Business Week Daily.
Is that what they say? Is that what you learned?
Yeah, I've been speaking Italian.
Oh, wow, I'm very impressed.
Driving everyone nuts.
Still waiting for those.
Impossible to understand.
Still waiting for those Olympic chocolates. Just saying. We'll see you again.
They're by my desk. You can come over.
We'll see you again. Same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. When we come back, we're going to talk about the world of credit with Christina Lee, co-portfolio manager for Oaktree's U.S. private debt strategy. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bossitt. Great to be back in the seat, but kind of a nothing day here on Wall Street. You did see some dip buyers come in, trying to find some bargains, but that kind of ran out of steam as we got closer to the close.
A bit uninspired when it comes, of course, to the public equity markets. But our top story this hour, of course, is AI anxiety continuing to grip Wall Street. The iShares Expanded Tech Software Sector ETF, or its ticker IGV, has been front and center of the AI disruption trade, falling 2% actually on this day. Now this as a handful of private software firms actually opened their books early to calm those investor nerves. Many private lenders from Blue Owl to KKR coming out in recent weeks to defend the sector, arguing that there are plenty of borrowers that will benefit from AI, Romain. So an active conversation.
Well, let's hear it from somebody who knows a lot about this, the co-portfolio manager for Oaktree's U.S. private debt strategy, Christina Lee. She joins us right now here in Studio 2 in New York. Christina, great to see you here.
Thank you so much for having me.
I know you're probably being tired of asked about what's going on in the software sector, but I'm going to start off asking you about what's going on in the software sector. Are you comfortable entering into new positions, making new loans effectively to these companies, knowing what we know now?
Yeah, I think that's a really interesting question because I think over the last 2 weeks, you've seen really the headlines around private credit and software, right? I think I've seen SaaSpocalypse, Loanageddon. I think there is a higher bar for new software names, and one of the reasons for that is, frankly, the existing exposure of software in private credit. Software has been one of the largest end markets or industries for private credit over the last few years because that's where deal flow has been. And private creditors, initially, why did we like software? One, annual recurring revenues, right? Very sticky usually. Two, high margin asset-light business. But I think now with where AI and all the developments in AI, it's the key question that we've always discussed is disruption, displacement. Yeah. How does that look for a company? So I think a lot of private credit firms are going to have a much higher bar in terms of adding exposure. I have a feeling they're going to look to actually diversify into other industries, whether it's industrials, healthcare, to make that exposure actually lower.
Well, that's what I'm curious about, too. On the software side, though, when we talk about the potential disruption, we're still talking potential. I mean, is there a way? I know you don't have a crystal ball, but what's the runway for that? I mean, it's not like, okay, in 2 quarters, all of a sudden, those margins and that recurring revenue is going to disappear, or will it? Or is it like a 10-year story where if you are selling debt and assuming it's not like, 30-year debt, maybe you do have some modicum of safety?
Yeah, I think it'll be really interesting. I think right now, if you ask a lot of the private credit lenders, they're going to say you're not actually seeing any softness in their software portfolio companies. The real question is going to be around exit value or terminal value. So when that maturity comes up in the next few years, can you get refinanced out? Or can the sponsor, for example, exit that? I think you're going to have a tale of two cities there. I think you're going to have some software companies that are going to do well with AI. For example, they already have an AI roadmap. They're well entrenched in a lot of companies. They're very sticky. Then there's probably going to be a whole set that probably can be displaced, right? We think of certain companies like coding companies, for example, or what we call single point. They only do one piece of the software, those are most likely easily to be displaced and could have some exit value issues there.
Right, that ultra specialized sort of coding company that exists out there. I do want to go back to what you were saying about basically exposure to software when it comes to the private credit industry, because there's been a lot of debate around that point, especially when it comes to BDCs. I mean, from where you're sitting, the visibility that you do have, what does that exposure actually look like? Because the fear out there is that, you know, you have maybe positions that a lot of people looking at it would consider software, but it's not necessarily being classified that way.
Yeah, so I think one of the things that we always look at, and that's always been a debate, is what matters more from an industry classification. Is it software? Is it inherently a software business? For example, does it have recurring revenues? Is it subscription based? But there's also an overlay of the end market is actually really important too, because that can also drive, for example, the growth, the stickiness of that revenue base. And so I think, for example, the best way to do it is say, this is my software exposure, but within software, this is my end market. Because those two data points together are actually pretty important to understand kind of how sustainable or how your portfolio may hold up.
And Christina, I also want to talk about, you know, your expectations for 2026 as well, because taking a look to some of the notes you sent over to our producer when it comes to direct lending, you talk about this imbalance that we've seen when it comes to the supply of deals and the demand from investors and what that looked like in 2025. How would you expect that supply-demand balance to evolve come 2026?
Yeah, I think that's going to be a really interesting question, because I think, one, when you mentioned the BDCs and the noise around software, what happens to those inflows? BDC inflows are a big driver of dry powder in private credit. It's kind of too soon to tell what this year may ultimately come out. But I think you're going to see more M&A. And I think where you're going to see more M&A is in that industrial, healthcare, I call it non-software space, because I think people will be chasing deals in those industries to really, again, diversify away from some of the larger software exposures that you've seen over the recent years.
This gets to that idea, though, too. You know, how much capital are people sitting on? I mean, people like yourself and your ilk sitting on right now to be able to deploy immediately. Do you have it?
We don't have, I would say there's not a real good sense of that, because not only are there BDCs, but for example, there are private commingled funds. So there's not really an inherent good proxy for dry powder. But where you see that manifest is in deal terms, right? You kind of know there's 6 lenders competing for a deal, the pricing's getting tighter, the covenants may be getting wider. That is your leading indicator of it's competitive and people are sitting on dry powder.
You've been doing this for a while. I'm curious, are there any parallels that we can draw between what we're going through in this current credit cycle, or whatever we want to call this, and maybe what we saw in the past? Or is this just so unique that we shouldn't make those comparisons?
I think it's pretty unique. So, because AI is so disruptive, right? Think about your own lives and how AI might be additive or detractive. And it's such a burgeoning technology, it's hard to say. I do think, though, on the enterprise side, right, big companies, especially those very large companies, they tend to be sticky. They have inertia for technology. I think about the cloud. Remember when everyone was kind of on-prem, they had their data centers in the building, and moving to cloud, and how long that took. And actually, there's still a lot of companies that are on-prem. So I do think that some of that AI transition will be slower for especially the large enterprise customers, because there can be inertia around that.
And we should point out, I mean, as you bring that up, we're getting a headline now across the Bloomberg terminal involving another deal out there involving NVIDIA and Meta, basically Meta deepening its ties with NVIDIA. We're now learning that they have announced a multi-year partnership with Meta, Katie Greifeld, and that partnership will span to on-premises, of course, the cloud, and of course, AI infrastructure, and seeing actually a pretty sizable move in both of those stocks here in the after-hours trade.
Yeah, absolutely. You can see shares of both companies higher by about 1.5% here. Really a sign of the times sort of headline that we're having break there when it comes to that partnership between NVIDIA and Meta, which will continue to follow. But Christina, I want to go back to what you were saying about the pricing. You know, let's say you have 6 lenders competing for a deal. You have seen those prices tighten. But I mean, what kind of compression are we talking about? And how much more can some of those prices really compress before maybe, you know, some just drop out?
Yeah, I would say where we've seen pricing kind of compress to is around the kind of the S plus 450 area. That's where we feel like lenders, and even in this really kind of better environment, kind of sit in. Though the big question is, these are floating rate loans. What happens after May when Powell is out of a job, right? I would say some people are saying, hey, actually, if SOFR goes down, will spreads go up? We just haven't seen that in 2025. For example, in 2025, SOFR was declining, but we also saw spreads decline. So the question is, what happens really when SOFR declines? Will spreads increase to offset that, or will they kind of stay in the 450? It's too early to tell.
It's going to be fascinating. I think that a lot of industries are going to be asking similar questions once we see rates come down, if they do, in a meaningful way. Christina, great to get some time with you. That is Christina Lee. She is co-portfolio manager for Oaktree's U.S. private debt strategy. A really interesting conversation, especially when it comes to software, Romain, because I know you've been in Milan for the past week, but that SaaS apocalypse, I mean, it just rolled like a wrecking ball through a bunch of different industries.
It did, but it gets to this idea, too, of, I mean, obviously the money's still flowing. We were just talking about that Meta headline and NVIDIA in terms of the infrastructure side of this, the cloud side of it as well. And does it matter if some of those software companies maybe aren't the beneficiaries, or maybe they sit on the sidelines for it? I mean, it looks like that's where some of the rotation is going, but it'll be interesting to see whether anyone comes back once maybe this dust clears.
Absolutely. Well, coming up next on The Close, it's also 13F season, so those filings trickling in with Tiger Global slashing its stake in Microsoft. We're going to discuss after the break. This is The Close on Bloomberg. Well, it is 13F season, and investors are digesting the latest round of filings with major moves coming from the tech sector. Berkshire Hathaway reducing its stake in Amazon, Pershing Square adding Meta, and Tiger Global slashing Microsoft. Let's get right to it with Bloomberg's Hema Parmar. And let's talk a little bit about Microsoft, because as I mentioned, Tiger Global making some moves with that name.
Really interesting. You know, with the 13Fs this time, we have seen such a fascinating correction this year that when we look at these 13Fs, which show us what hedge funds did in the fourth quarter of last year, we can actually see who might have been prescient and who might be struggling. So with Tiger Global, they slashed their stake in Microsoft by nearly 16%. Wow. Microsoft has tumbled more than 20% since the end of September, which is the last time that we were able to get a glean into how these hedge funds were trading. So that probably helped their portfolio. It is still one of their biggest positions. They also trimmed down Amazon, trimmed NVIDIA and Meta. So you do see them bringing down their market exposure by more than $2 billion.
But then you look at something like Soros, and I see a headline crossing the terminal. They boosted their stake in Microsoft.
They boosted their stake. It is its fifth largest holding. And they also added to Apple, added to NVIDIA, added to Amazon. Okay. So you can see that that probably didn't work out too well for them at the moment. This is a very big portfolio, over 200 positions in the Soros fund. But this is great because you can really see how divergent their positioning was at that point. And you can see really how that may have played out for them if they haven't adjusted since then. These filings are as of December 31st.
Yeah, it's interesting to see two sides to the trade here. Let's talk a little bit about some of the Tiger Cubs that we've seen filed so far. What are some of the headlines there?
Are they still Cubs? We've been calling them that for a while. I feel like they're full grown now, right?
They are. They're full grown. They're well into their new lives here, but they will forever be descendants of Tiger Management. And we'll have that title honorific on to them. So as we look at one that just crossed, Lone Pine, they ditched their stake in Meta entirely. That was their biggest position, and they have sold out of it. And this is a stock that has fallen since then. So again, might have worked out well for them, given the volatility we're seeing in AI, we're seeing among these big tech concerns in the space. And so that seemed to have worked out well for them.
So I am curious. Our producer said you wanted to talk about University of Texas.
University of Texas.
Why?
The University of Texas. So on the flip side, we've talked about the varying positions. They did trim their Microsoft stake. They did also trim their Amazon stake. They ramped up their Apple position to become its third biggest holding. So that stock has weathered the storm a little bit better. We're looking at the returns since the end of September for these stocks because that's the last time that we have looked at this book. We don't know with 13Fs, we should keep in mind, we don't know when these hedge funds change their position. It could be the first day of the fourth quarter or the last. We don't know the shorts or any hedges against this. So it gives us a little bit of a look, and we'll take that. Hedge funds are so secretive, but we should keep in mind that the data is old as of the end of the year. They likely have changed and adjusted their position since, and it doesn't show us the complete portfolio of these long short funds with which both hedge in various ways.
But the general gist of what you're getting, and I know this is all kind of coming in real time right now, this is still a tech story in terms of where they're putting their money, or at least the big bulk of their money, a tech, AI, structural story?
Definitely when you look at the Tiger Cubs, they tend to travel in packs. They tend to really invest long consumer, long technology. Not all of them, but many. And they tend to have more concentrated positions. And so when we're really curious to see the rotation in that, especially because many have been quite bullish on AI. And so it will be curious to see actually next 13F season how they were positioning right now.
All right, Hema Parmar, who covers all things 13F for us here at Bloomberg. The one thing she didn't mention was Bitcoin and crypto assets. In fact, we're going to talk about that when we come back after the break. The hunt for clarity in the digital asset space, that's continuing as the SEC's Project Crypto enters its next phase. Lilya Tessler, she's the head of Sidley Austin's global fintech and blockchain group. She's going to be joining us after the break. Stick around. This is The Close on Bloomberg.
Shares of Gemini space station plunging today as 3 top executives depart. The crypto company that was founded, of course, by Cameron and Tyler Winklevoss, losing its COO, CFO, and chief legal officer, raising fresh concerns around solvency as cryptocurrencies stay under pressure. Joining us live to unpack this move is Stacy-Marie Ishmael. She is executive editor over at Bloomberg News. So this is a company, it's hard to even know where to start because this is a company that very recently went public. To see 3 of their executives leave in a single day, I mean, what do we know about what was behind these departures?
Well, what they haven't said, or they haven't directly attributed to this to, is the decline in crypto prices. That pretty much, they IPO'd in September 2025, and things went very poorly for the digital asset market almost immediately after that. But they did, maybe it was like 12 days ago, announce they were also laying off a substantial proportion of their existing company, closing operations in the European Union and elsewhere. So this is clearly a company that is, in a lot of ways, pulling back from where they started, right? They're retrenching in crypto. At the same time, late last year, they got approval to get into a derivatives exchange, and we expect that they will soon be announcing, or at least be announcing sometime in the future, that they're going to be more involved in prediction markets, which are, as you know, the new hotness in town.
Oh, gosh. Oh, okay. All right. I want to show you out. We spent all last week, the other week, talking about prediction markets. But in all seriousness, though, this gets to the question here as to whether this was a function of timing, whether kind of the Winklevoss twins kind of got into this too late, at least with regards to this particular corporate structure. And that is maybe the reason why, particularly when you compare it to maybe some of the OGs in this space that are not only hanging on, but seem to be thumping their chests and saying, we're going to be all right.
I mean, I will say that the Winklevi are themselves OGs of Bitcoin. That's how they made their money. They were super early into it. One of the challenges that they have always had is just market share, right? So, they pre-announced, or they signal to the market what their earnings are going to look like. One of the numbers they released is that they have about 600,000 monthly transacting users. For Coinbase, it's closer to 10 million in the last quarter. So they're operating in an order of magnitude different as it relates to just like who's on the platform, who's using them as an exchange. And that's been true from the very beginning.
And so, of course, Gemini, I have to imagine that some of these issues that they're dealing with right now are specific to Gemini, some nuanced concerns there. But when it comes to the crypto landscape overall, and you think about this plunge that we've seen in prices, not just in Bitcoin, but across the board, what kind of pain, if any, are we seeing sort of play out across the ecosystem?
I mean, one thing we're keeping a close eye on is folks who are still primarily venture-backed, so they have not benefited from being able to tap public markets, who maybe raised money 18 months ago and are now going back to investors and saying, hi, we would like some cash, please. We've certainly seen a lot of interest in companies trying to get banking charters and licenses in an attempt to diversify and, get into different kinds of both markets, but also funding opportunities. But I do think that the pivot to prediction markets, as it were, is like a real thing that has absorbed a lot of the rhetoric around this industry, but also, frankly, a lot of resources.
All right, Stacy-Marie, always a pleasure. Stacy-Marie Ishmael, executive editor here for us at Bloomberg, as we continue our conversation about what's going on in the crypto space. Of course, Bitcoin has been under pressure, particularly of late, as some concerns here about what's been going on the regulatory and legislative side. In U.S. politics, crypto clarity is likely a top priority for 2026. 2026, according to our folks over at Bloomberg Intelligence. The CFTC, the SEC, formally reshaping their new regulatory framework known as Project Crypto in a joint effort meant to bring more structure to the market. Joining us right now is Lilya Tessler, who helps to advise folks on what that structure is or maybe what it could be. She's the head of global fintech and blockchain over at Sidley Austin. Lilya, great to have you here.
Great. Thank you so much for having me here, too.
So where do we stand right now? I mean, because there's been a couple of developments here that have actually, at least over the last few weeks, that have led to some of the softness that we've seen in Bitcoin. One is whatever legislative progress was being made, that seems to have stalled. And then now on the regulatory side, I know there's been a revamp here of Project Crypto. Are we any closer to seeing a more, I guess, a finish line in this whole process?
So Project Crypto is an initiative that was started by incoming SEC Chair Atkins last year. In November, he announced it. But even before he was elected as SEC Chair, we already saw the SEC's Crypto Task Force rolling out guidance, proactive guidance on a lot of the initiatives that the industry was looking to see. And then a lot of those issues got rolled into Project Crypto. And some of those, since last year, we've already started seeing guidance on. One example is tokenized securities taxonomy that we just recently saw released a few weeks ago. What we, in the last month, have seen is the Project Crypto SEC initiative coming together with the CFTC, and now that the CFTC has an incoming chairman that's also focused on regulation in this area. Project Crypto is now becoming a coordinated effort among the two agencies, which is consistent with the legislation in this area.
But what's the time frame, too? Because, I mean, we talk about the Winklevi and all these folks, microsale. I mean, these are kind of the gunslingers in the Wild West. And the whole idea of having the regulation, having the legislation, was that it would provide enough guardrails for kind of the more traditional folks, the more risk-averse folks, financial institutions I'm talking about, to enter this space full on in a way that they haven't really, or at least felt like they haven't been able to do.
Yeah, and the regulatory guidance and clarity and anticipated rulemaking has started coming out of the SEC and CFTC, and we're going to see more formalized rulemaking, I think, in the coming year, most likely. And that has brought a lot of the institutional financial institutions, a lot of investors into this space that otherwise weren't participating. A few examples is we've seen tokenized securities in the form of tokenized money market funds. We've seen tokenized gold products. We're going to see a lot of tokenization and different use cases of this technology across different sectors. It just takes time for the formal rulemaking process to really see its true potential, and that just requires patience for a lot of the industry to kind of wait and see how it gets shaped.
Well, what do firms within the industry do between now and then? Because you make the point, I mean, progress is still being made. You're seeing, products launch here, but it feels like a little bit of purgatory as we wait for that clarity on the regulatory front.
What companies are doing, and we're bringing them in, is really to go to Washington, to meet with the regulators, to meet with the SEC Crypto Task Force, provide formal submissions, provide education, what the technology is, what the capabilities are, and what rules of the road will help these companies navigate into the future and provide a flexible framework for the technology to evolve and develop. That is all happening in real time. The regulators and the SEC and the CFTC are open to those meetings, and many companies have taken advantage of that. We've seen already out of the SEC no action relief issued on areas from guidance on stablecoins not being securities to proof of work and proof of stake blockchains, and that those activities not falling within the SEC's jurisdiction. We've seen DPIN, decentralized infrastructure provider guidance, and we'll see more in the form of no action relief. Just this past Friday, we saw the current director of corporation finance saying the next coming months and into the summer will be busy for the Division of Corporation Finance. They anticipate releasing exemptive relief, no action relief letters. So we're going to see a lot more in the near term, and in the long term, we will see rulemaking. Which may align, and I think we'll have to see what happens on the legislative front as well.
Well, let's talk about what the ideal vision for the long term might look like, because you think about some of the different things that we're talking about when it comes to Project Crypto between the SEC and the CFTC. It feels a little bit like alphabet soup, and it has for a while. And then you have Congress, pursuing their own things. When you take a look, at some sort of end goal here, I mean, what would true clarity look like when you think about how that framework might knit together?
Well, the SEC and the CFTC is coordinating with Congress and the Senate in terms of drafting the legislative market structure bill, which, if that moves forward, that will provide clarity for the SEC and CFTC how to shape their rule book. In the meantime, they're not waiting. They are shaping rules that are within their existing jurisdiction, and it may fill some gaps that the legislation hasn't even contemplated. So I think it'll be interesting to see how all that plays out through the next few months in the summer.
I'm just curious, though, too, about this idea. Are we adding unnecessary complexity to this market? I know there's this idea of guardrails and people want to have a little bit more clarity, but is it starting to get muddled to the point where we're adding so much complexity to it that it could actually hamper some of the growth in the industry?
I think the objective is not to hamper innovation. It's really to allow innovation. And practicing this area primarily on the securities law issues over the years, there's been not necessarily clear guidance on what activities fit within the SEC's jurisdiction versus what fits in the CFTC's jurisdiction. And this joint initiative of Project Crypto really is intended to provide that, to provide a taxonomy of there are securities, tokenized securities fit clearly within the SEC's jurisdiction. Digital commodities, those fit in with the CFTC's jurisdiction. And there's certain products that could potentially overlap, and that's where there's going to be a memorandum of understanding between the agencies to figure out how can entities operate in this space and have a clear roadmap in this gray area.
All right, Lily, really great to get some time with you. A really interesting conversation here. That is Lily Tessler. She is head of global fintech and blockchain over at Sidley Austin. Meanwhile, let's take a quick look at some of the after-hours movers on this Tuesday. Of course, it's still earnings season as we await NVIDIA next week. We did get some numbers from Palo Alto Networks. You can see shares down over 4% at this point, pretty much flat when it comes to Kenvue. A different story as we move down the board. Yeah. Some green actually on the screen. Caesars higher by about 2.6%. And Toll Brothers higher by 1.6%.
Yeah, we should point out we're still awaiting those report out of Kenvue. Toll Brothers did just cross the wire here. Deliveries actually, the forecast for deliveries actually missed estimates here, but the numbers for the current quarter did come in slightly above estimates here. You see the numbers there on your screen. As far as the knee-jerk reaction, 1.63% up on Toll.
This is Bloomberg.
You know, we were talking a little bit earlier in the show about some of the softness that we're seeing in the fast casual space. But fine dining, that's actually picking up some steam here to start 2026, with recent data showing a rise in same-store sales, average check growth, and overall foot traffic at high-end restaurants. Here to discuss is Chip Wade. He's the CEO of Union Square Hospitality Group, which of course owns several fine dining establishments here in New York, like Siciliano and Manhattan, Gramercy Tavern, and quite a few others. Also the owner of Daily Provisions. Great to see you again, Chip.
Great to be here. Thanks for having me.
Let's talk about the fine dining space, where a lot of people associate Union Square Hospitality with that. Are you seeing a little bit more resiliency with regards to not just foot traffic, but what people are actually spending in the restaurant?
Without question. It's the strongest segment of the business that we have for Union Square Hospitality Group. Our businesses like Gramercy, like Union Square Cafe, and more recently Manhattan, are seeing sales lift as well as increase in event business specifically, which is great news. And the event business is driven by both business and social. So all of our businesses, generally speaking, are seeing uptick in revenue. Same restaurant sales are up. And then it's driven in large part by the event business.
With regards to the event business, is that primarily corporate customers, or is this individuals, you know, getting married or doing whatever?
Yeah, it's a little bit of both. So it's about a 50-50 split. As you would imagine, Monday through Thursday is big corporate events. And then on the weekends, you have wedding, bar mitzvahs, et cetera, that drive the social part of our business. Yeah.
And I don't know if Daily Provisions counts as fine dining, but boy, do I love Daily Provisions. It's a great place to get like an egg and cheese on a roll, but a little bit elevated there. One recently opened up on the Upper East Side, and then I moved out, so I missed it.
Did they not have one in Hoboken yet?
They don't have one in Hoboken.
Okay, well, you should talk to the CEO. He's right here.
Well, then I was going to ask, tell me about your expansion plans there when it comes to Daily Provisions and the footprint that you have.
So we call Daily Provisions fine casual, so it operates in the space of fine casual. We have 12 today, including more recently one inside the new JP Morgan headquarters, right? And that is That restaurant is performing exceptionally well. It's just for the clients and the employees that work at JP Morgan's, and it's a different model.
And Katie Greifeld.
Yeah,
she said put it in. So.
I have to ask, I mean, how did that come to be? I, have actually spent some time in the JP Morgan headquarters, and like you said, I mean, you only have 12 stores or so. So, I mean, how did it come to be that one of them is in JP Morgan's new headquarters?
It really came from a really strong relationship that we have with JP Morgan and our partners at Restaurant Associates. So we played an instrumental role in helping to design all of the F&B programming at the headquarters. And as part of that, we said, wouldn't it be great, and Jamie said, wouldn't it be great to have a daily provisions inside their offices? So it's Monday through Friday, basically 7 to 6 every single day. And again, it's performing exceptionally well.
I do want to talk about your expansion plans. I mean, look, opening up in the JP Morgan building is pretty low risk, I would think, given the clientele you would have there. But you've been expanding into other cities as well, and you've got a couple of projects underway. Talk a little bit about that process, and also just, I guess, some of the challenges that you've had to sort of face in order to make sure that things get up and running smoothly.
Sure. We're very excited about Daily Provisions. Again, 12 cafes today. We'll open 3 this year, including 2 in Boston, and we're going to build out in the DC market. So we're growing at a modest pace. And we're growing where it makes sense from a human resources, from a tech, and from an operations perspective. So scale matters, but I never want to grow faster than the human resource talent that we have on board.
Well, that's what I'm curious about, is that how far you want to go. And for the viewers that don't know, I mean, Union Square, of course, founded by Danny Meyer. You effectively took over for him, at least in terms of day-to-day operations of the business. And you have kind of pushed us beyond New York City into other markets. I know you're supposed to open up something later this year in Detroit. I mean, how much further do you want to take it?
I would say we never want to outgrow what our human capacity can handle. And so we've grown a lot of with regard to daily provisions last year and 3 this year. It's likely that we're going to pause, just slow it down a little bit so that we can capture the learnings. Entering a new market comes with new challenges. Is the brand going to be received well in a new community? And we're going to keep learning a lot. And so 20 this year, we'll open 3 daily provisions, and then we need to continue to learn from our workforce and from our guests about the particular brand. The fine dining will grow slower, right? I really want to make sure that our capacity, because it takes a lot of work to open a fine dining restaurant. You're hiring executive chefs, master somms. These are really big, important roles. And what's really important to us is that we deliver on enlightened hospitality wherever we open our restaurants.
Just one last point on daily provisions. There is a lot of great real estate on Washington Street in Hoboken, New Jersey, but I hear what you're saying, that you don't want to grow faster than your human resources. And that brings me to AI, because that has been one of the conversations. It's how we opened the show today, was what could AI mean for productivity when it comes to the labor market? And I wonder what that means in your industry, whether that's something you see as realistic in a realistic time frame.
So we're knee-deep in understanding AI. We've been at this over the past year. We have a fantastic chief technology officer who has really rolled up her sleeves to better understand how we can deploy AI. Where it's going to come to life in our space is really at the home office, at whether it's finance, whether it's the legal, whether it's marketing, first to use AI to solve some of the issues and bottlenecks that are happening at the corporate office, our home office, less about the restaurants. Now, we're going to gain some efficiencies by deploying some of the AI models to help us for menu design, layout, and pricing. So that will have an impact within the 4 walls of the restaurant. But first, I see integration at the home office.
But just real quickly, I mean, how much are you using data to sort of track what your customers are buying, what they are not buying? I assume that's got to be a part of the business?
It's a big part of it, and is absolutely critical. And we want to be able to use the data to influence the guest experience and the hospitality experience. And we're starting to get data that on our most loyal repeat guest that says, for example, Chip likes bourbon and he likes a specific bourbon. So when the server approaches the table, she knows your name, she knows the frequency of which you've dined at our restaurants. So she doesn't ask you whether you want red wine or white wine. She knows your preference on bourbon.
All right. Well, Chip, Romaine likes rye, so put that into the daily system.
I'll make sure that happens.
There you go, Chip. So enjoyed this conversation. Come back soon. That is Chip Wade of the Union Square Hospitality Group. He is the CEO. Meanwhile, a quick look at earnings here. We're taking a look at Kenvue. Those earnings finally coming out. Adjusted EPS for the fourth quarter coming in at 27 cents. The estimate was for 22 cents. Net sales also coming in a bit higher than expectations. When it comes to the forward outlook, you're not going to get one because due to that pending transaction with Kimberly-Clark, the company will not be providing forward-looking guidance.
And also, not earnings here, but keep an eye on SanDisk right now. The share is down about 3%. Western Digital, of course, one of the main holders of the shares, said to offer about $3.1 billion worth of shares into the market here. So a bit of dilution here for, of course, one of the highest flying stocks over the past year or so, a stock in SanDisk that has already doubled just to start 2026. All right, when we come back, we're going to set you up for what to watch. Stick with us. This is The Close on Bloomberg. Sort of a blah day here on this Tuesday afternoon, a holiday shortened week, but here's what to keep your eyes on over the next 24 hours that could move markets. We got some earnings, Kitty Greifeld, some that actually, could potentially maybe paint a picture for us about the economy.
Yeah, absolutely. DoorDash and eBay, that's coming, as well as Booking and Carvana, as well as CRH. So a nice smattering of industries and, like you said, really different angles into the consumer.
Yeah, and then when we want a straight read on the economy, we are going to get some economic data before the bell tomorrow, including durable goods, housing starts and building permits. I'm actually kind of curious to see, what we learn out of some of the housing numbers, because there's been a lot of talk here. Remember, the spring home selling season is, in theory, going to be kicking off in about a month or so, and you wonder if it's going to be as slow as the one we saw last year.
Yeah, big time. Certainly will be interesting there. Of course, that feels like the appetizer for some of the data points that we're going to get later in the week. We also get industrial production. That is coming at 9:15 a.m. tomorrow.
And, I mean, keeping on the economic theme here, we're going to get the Fed minutes from the last meeting. Of course, we kind of know nothing really happened at that meeting, but I always think it's a good read to hear to see how aligned they are on things. And of course, as we try to get a read for the next meeting, which is, I think, just 4.5 weeks away.
Yeah, I mean, Fed minutes, they're a little bit stale, but there's a lot of discussion within the Fed right now.
I read them intently. I put them side by side. I look at this one and that one.
Can't talk to Romaine while he is reading those Fed minutes. Just a must read.
Keeping eyes on the after-hours trade as well. SanDisk, Palo Alto, some of the movers. We'll be back tomorrow. This is Bloomberg.